time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Your stock, our take on listener question here. Parex is an oil and gas company you have recommended in the past. What are your thoughts on it today, Sandy from Moncton, New Brunswick? Well, Parex, symbol PXT on the TSX, trades at around $21, $2.3 billion market cap, 4.76% dividend yield. They are a Canadian-based oil-weighted producer focused on conventional high productivity reservoirs in Colombia. Cash on the balance sheet and material free cash flow and an active normal course issuer bid. Parex is a solid international exploration production company that you could look at for a portfolio. So essentially we'll look at it here. Near-term outlook. What did we see in terms of revenues in the last quarter? Q2 revenues were up 63% to $345 million. Income before income tax rose 112% to $269 million. Earnings per share were up to $1.24 from 72 cents in the same quarter last year. Production, though, was basically flat. Its production is combined crude and conventional natural gas, weighted towards light sweet crude. It was basically flat at 51.14 million barrels of equivalent per day. Now, what produced the huge financial growth then? Well, it's higher light sweet crude prices. That would has driven the overall growth. But there is potential growth coming in terms of production for this company, what makes it a little more interesting. They had production guidance in the last quarter. Production was expected to average between 53 and 55 million BOEs per day, which is decent growth. Full year 2022 production to be around 54 to 56 million BODs per day, with an exit rate of about 60 million BODs per day. There was a recent announcement, however, that essentially weather and blockades have brought down volumes for the upcoming quarter. They're now expected to average 51.5 million BODs per day, below previous guidance of, like I said, 53 to 55. Now, these should be one-time events that should allow them to get ahead. Current volumes after those delays have come in at 55 million BODs per day. So that's ahead of its forecasting the 60 million exit rate. So it's ahead of that forecast. So while this quarter will be affected over the long run, and heading into the end of this year, the company should be able to be on target to its exit rate that we talked about. They also announced a solid discovery in that quarter. So our take here, the company just completed buying back 11.8 million shares in an NCIB. They should institute another NCIB as well. The share count has been reduced. It's around 109 million shares outstanding. We estimate there's US 225 million cash in the bank net position. There's about a third of that they've promised of the cash flow. Sorry, not of that, of just cash flow is expected to be returned to shareholders on an annual basis via those buybacks and also a dividend. So the company is very shareholder friendly. Valuations, the stock trades at approximately 2.33 times expected this year's cash flow and 1.35 times EV to EBITDA. Those are low valuations. Having said that, cash flow can fluctuate very significantly with energy prices, which makes any oil and gas producer risky if you're just going to base it on that and say, oh, it's cheap based on this multiple. That can change 1 year out if you have a drop in those energy prices. Parex itself has a cash-rich balance sheet, which bests most of its peers. The dividend is attractive. Again, one should never buy a commodity-based business solely for the dividend, but the stock would rank relatively highly if growth can accelerate in a volatile conventional energy sector against its peers. It will remain volatile, however, but in our universe, this is a company that's bested many with its cash-rich balance sheet and good shareholder-friendly policies. So we continue to monitor Parex.